You are listening to Keystone's Stock Talk Show, episode 258.
If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook, and keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold.
It's great to chat with you again this week, on a week when my co-host, Mr. Aaron Dunn, was seduced by the summer sunshine and has abandoned us for Vancouver Island. Never fear, the Killer Bees have promised to fill in admirably. I will start this week's episode with a look at how investing in just 2 to 3 truly great stocks in your lifetime can be game-changing in your portfolio. In our Your Stock Our Take segment, Brett answers a viewer question on Sabio Holdings, symbol SBIO in the TSX Venture, an ad tech company focusing on connected TV and mobile ad monetization. The stock is down 64% over the past year. The viewer asks if Sabio is on sale or more of a falling knife. Finally, Brennan answers a viewer question on Cannara Biotech, symbol LOVE or LOVE on the TSX Venture, a vertically integrated producer of cannabis and cannabis-derived products for the Canadian markets. Cannara owns 2 facilities based in Quebec, spanning 1.6 million square feet. The stock is off 18% year-to-date, but both revenues and adjusted EBITDA showed solid growth in the last quarter. Brennan will let you know if the situation is improving for Cannara or whether or not the listener may be able to ride the stock to a new high. Terrible pun intended. Let's get to the show. Minus my co-host, Mr. Aaron Dunn, we have the Killer Bees, Brett and Brennan. How are you guys doing? How was your weekend? Anything crazy? Brennan, you're back. Brennan's back from another stag-at, right? How would that go?
Another stag-at with all the boys. Mm-hmm. But no, it was just a golf trip, basically. I golfed pretty well, so I was happy with that. And it was beautiful up north. I know I sent Ryan a picture one night, and I can't remember what I said along the lines. It was something like good old flat Sask or something, but it was a beautiful sunset
just
over Waskesiu Lake.
I immediately deleted
and we ended up I ended up watching game 6 of the Stanley Cup Finals, and the Oilers obviously won. We're gonna have game 7 tonight. I mean, this is gonna air on Tuesday, so we'll already know I'll either be a very sad boy or a very happy boy.
Yeah, it is historic. It's never happened in this fashion in a Stanley Cup final, if they can pull off the win here. So we shall see. It'd be tough for me to watch I think it's been impressive to watch. I mean, I like McDavid as a player. I like some of the players on the team. Edmonton has had 5 Stanley Cups, and I've said this again, Vancouver has 0 in 700 years. So, it would be nice to, we'd just like to have one before you guys have another.
I mean, I wasn't alive though for any of those Stanley Cups. So
I'm speaking to the listeners, not just you, Brennan. I know it's all about you on here, but I'm speaking to the listeners. I'm kidding.
That's fair.
But we'd just like to have one before the entire, anybody in Alberta or the rest of the country, for the love of God. I guess Winnipeg's never had one, so we could have some sympathy there. But the franchise hasn't been around as long as the Vancouver franchise. So, all right, let's move on. There was a poll question. Oh, I was going to say too, there was a stag-at next to you though, Brennan. Was there not?
There was. I mean, I don't know how much I want to say about it.
No, you should say very little.
But no, there was some lovely ladies that were.
I think Brennan said older, and then he mentioned they were in my age range. So I said, "Thank you, Brennan. Thank you very much."
And they came over to our cabin and dragged us out and wanted to party with us. So we partied with them a little bit, and it was a lot of fun. Again, the thing is you never really grow up. I mean, that's one thing. I always have like a self quote that I always say. My favorite thing about growing up is realizing that you never actually grow up.
True.
Because it's true. I mean, maybe some people do, but
not you.
not me,
Ah,
and not
all
those
right.
ladies.
Either of you.
Well, at least for that weekend, that's good.
Mm-hmm.
All right, let's get to the poll question. I'm going to get Brett to look at that for us. It kind of dovetails into the topic that I'm going to be talking about briefly today. And I'm going to do a couple weeks on this subject because it dovetails into how many stocks you should own in your portfolio as well. But here's the simple question we had from this week, so you can take it away.
Yeah, so a nice and simple question. How much of your equity investment portfolio is comprised of individual stocks? Completely or 100% came in at 40% of our votes. Mostly or 75% came at 38%. Roughly half came at 10%. Minimal or 25% came in at 6%. And the people who hold no individual stocks came in at 6% as well. It's always a bit interesting because obviously our audience does skew. I think we are a bit of an anomaly. If you were to ask the broader audience, you'd have more people investing in ETFs and mutual funds, which are really the two big alternatives, especially with how many people you have pushed towards passive investing these days and just buy and hold one, maybe two ETFs and then call it a day versus our audience, obviously.
Our entire concept is helping people build a simple 15 to 25 stock portfolio. So, and if this was a broader poll across Canada, you'd have, I think the results would be more skewed towards just holding large ETFs or mutual funds in the portfolio. Honestly, it's great to see that our clients and that our listeners are the majority of them are holding quality individual stocks. We hope we're following that. Some follow-ups would be, how many stocks do you hold? And we can maybe do that next week in your portfolio and give them some ranges, because I'm going to literally talk about, our philosophy next week on how many we believe you should hold in a portfolio, and, not holding two, not holding hundreds. And we'll get into that next week. But that, there we go. We've solved our poll question for next week. I'm not surprised, because our audience listens to us. Obviously, that's why they're listening to this podcast, that it skews that way. But it is certainly different than if you did that poll question across a broad Canadian audience, where they are just pushed into that type of investing. And, it's the mutual fund side of it. If we did a question on how many, mutual funds versus ETFs versus individual stocks, it would be interesting, because the underperformance or the pathetic performance really of mutual funds, we do seminars all the time. It's just better to own the low cost ETFs, particularly if you're just index investing. That's like the way that we would suggest it. So.
Well, I think that's the poll question for maybe next week, but go on, Brett. I won't cut you off.
Yeah, no, I just always find it absurd, because I'll see various financial influencers trying to huck
Dave Ramsey.
There you go. No, well, not him directly. No, this him for the mutual funds, but not these exact mutual funds. Where they'll try to be pushing these mutual funds, and then you look into it. All they're doing is a passive investment strategy, indexing, which is very simple to do. You can just buy, like in the US, you just buy SPY. There you go. You got S&P 500 ETF, and that costs 10 basis points. But then when you look into the fees of some of these mutual funds, they'll have like a 5 to 6% front load fee, and then they'll be charging 2% every year for effectively the same product, and sometimes even worse than what you can get just buying an ETF these days. So many mutual funds, whether it's like these individual sketchy financing companies, which always just avoid if they're those types of companies, but even then banks and stuff, that most of them, they'll charge you 1 to 2% for literally the exact same product, which you can get from a basic ETF these days for under 20 basis points even. And it's just been slowly going down over time as well. Like even 5 years ago, that might have been 20, 30, 40 basis points. But now that's even come down lower.
Well, I think Warren Buffett even spoke about that in one of his past Berkshire Hathaway meetings, or one of his letters, basically just saying, the average investor should be focusing on ETFs rather than mutual funds. I'm pretty sure he was quoting that.
It's the advisors that are advising that, they get paid more to do that, and that's why they're doing it. It's not in their client's interest; it's in their interest, or they're just old school. And a lot of them are just not the brightest. I'm going to say it. Like, if you're doing it that way, I don't know why you would be doing it. And if you're doing it yourself, and you just want to try to match the market, we talk about this all the time. Just use low cost ETFs. A simple process.
Yeah. Even you'll actually have some mutual funds, literally the exact same product. They'll list mutual fund A, version B, which it will normally be A and F, which depends if the advisor gets a fee or how they get their fee, which doesn't really matter for you. But then they'll also have the ETF of the exact same product, and that will be 20 basis points, 30 basis points less, which is just ridiculous to me.
Over time, you want to pay the less fees. So that's our soapbox for this week. We're going to have a quick show this week where we're minus a character on this show, but I'm going to get into just my segment. So we don't have anything else to talk about. I think we'll have more to dig into next week. So let's get to this simple concept. Okay, I'm going to start with what is a very simple concept. And this is that investing in two or three truly great stocks in your lifetime can be game changing for your portfolio. I talk about this when we do seminars across the country, when we do our 3-hour in-depth webinars, as well as one of the core concepts that we use. Now, this may sound kind of like hyperbole. In fact, you will find that it's not hyperbole, and you'll find that many of the great stocks and the returns that they produce are from some of the most mundane businesses, but they are great businesses, and I'll use some real-world examples of that as we go forward here. Unfortunately, you don't hear this concept from most financial advisors. And even more unfortunately, the traditional construction of Canadian portfolios inhibits you from creating true wealth based on great individual stocks in your portfolio. However, you can make simple changes to the structure of your portfolio to capitalize on great stocks over the long term. This is what we talk about in our webinars and when I give talks across the country every year. But don't take my word for it. In fact, this past year, Warren Buffett, perhaps the greatest investor of all time, stated that in his 58 years of Berkshire management, his satisfactory results, and we all know they've been far better than satisfactory, have been the product of about a dozen truly good decisions. That's one about every 5 years. So let that sink in. What he's saying is that only 12 great investments in stocks in his almost 100 years on this earth have made him one of the richest humans on the planet. It does not take many, and perhaps more importantly, they do not have to be complicated moonshot businesses that promise to change the world. Often they are the most boring, mundane businesses that you can imagine. Buffett, some of his greatest wins include Coca-Cola, a seller of soda pop, Bank of America, and American Express. All return tens of thousands of percent. They are a reminder of this. Boring businesses produce astonishing returns with less risk. I like to give real-world examples, and this is a real-world example we gave at a recent speech. You can see here. These are the type of boring businesses from our research today. Here are 5 actual keystone recommendations that have changed the fortunes of our client portfolios. Now, I put these returns up because they make us look smart. Quite frankly, Aaron, who's not here, like I said today, he really needs that. No, really, actually, the real reason I put these up is because these are the great stocks that we have recommended and invested in. And it's kind of to dispel the myth that you have to take on undue risk and make bets on speculative moonshot type businesses that promise to change the world in order to create true wealth in your portfolio. Most businesses, most often, these are just profitable, boring businesses that produce these astonishing returns. Let's look at these individual companies. Boyd, what do? They own automobile repair shops. They fix cars. Hammond Power, they've been around for 100+ years. They make electrical transformers. Boring, basic businesses. Expel, they sell automobile paint protection film. Water Furnace makes geothermal heating and cooling systems for homes. Not sexy, but you can see the returns here. Now, let me give you some real-world numbers to put this in perspective of how it can change the value of your portfolio. I'm going to give you an example portfolio here, a nice round number. We're going to say this portfolio is $500,000. You're going to buy 20 stocks. We believe in starting off with an equal weighting on those stocks. So you take 500,000, divide by 20, you get 25,000 in each. So equally weighted. At the recommendation prices, this shows the impact of 1 or 2 truly great stocks can have on your portfolio in the lifetime. You can see here, if you would have bought Boyd as one of your 20 stocks, $25,000 invested in it today, worth $3.18 million. $25,000, one of 20 stocks. Today's value on Hammond Power, $6.2 million. Game-changing returns from just 2 stocks in a portfolio, and really could have changed the wealth of your family over the last 2 decades if you had invested in those companies. So your next question may become, it's either how can you find the next Expel, Boyd, Hammond Power, Jana Systems, or Water Furnace in your portfolio? What do these great businesses have in common? Or number 2, how do you construct a portfolio to capitalize on these great, truly great stocks? Well, next week, I'm going to discuss number 2, or how many stocks, not shocks, how many stocks you should own in your portfolio. That's all I got for this week, but we'll get to that second item there next week. Any comments, or should we move on?
Oh, I mean, I've sat through that presentation many, many times before during all of our, or many of our seminars. That just
glazed over there? You just became a glazed donut? You forgot what was going on?
Yeah, I was snoozing. Felt like I was still on my bachelorette party. Just kidding. But no, I think that it is, truly important to hear. And I mean, if you did go to finance school, you would have heard, kind of like exactly how many stocks to hold. But even in university, I feel like, again, they, kind of lean towards the what we would term it diversification. Again, I'll let Ryan get into that next week. But just kind of like,
yeah, it's the financial planners model that really designed by big corporations, big banks, essentially, that has you investing in those banks, mutual funds. They get paid more for putting you in those funds. And like Brett said, the fees on the mutual funds that you're putting you on versus the ETFs are higher. Often, instead of buying just 3, you're buying 10 to 20. We've seen many portfolios that come to us with, with ETFs, or even, just mutual funds that own 150, 200 stocks, and they have 10 of them. We'll show next week that, you can make a significantly diversified portfolio with, 20 to 25 stocks, but you've literally bought hundreds of stocks. So you're buying the market 2, 3, 4 times over. So that means you're going to get the market return, and you're going to underperform due to those fees. Makes the banks and large financial firms a lot of money. It has you underperforming the markets over the long term. You literally can't outperform the markets because you are the markets, and then you get charged more for that type of arrangement. It's kind of the what we try to work against, and and we're trying to have a low cost way of building that portfolio, concentrating on good solid stocks, building that out over time. And next week I'll tell you how many stocks we think that you should buy, and we'll get into what types of stocks that we think you should buy in your portfolio as well in the coming weeks. So
or go on, Brett. Go on.
I was just going to say the one thing which, like, our methodology is really only possible in the last 20 years because direct investing really wasn't a thing prior to that. Now you have access to cheap, even in Canada, relatively cheap compared to, like, if you go to a big bank right now, it'll be $10 as a stock trade, which is still very expensive. But then if you look in their fee schedule, it'll be $35, $40, $50 to use a telephone trading platform, which is what you had to do before. So it's just become more accessible. So you don't need to use those ETFs if you don't want to. It's not something you need to do, because before, if you're paying $50 a trade, obviously, unless you have hundreds of $1,000s to invest in each thing, that can eat away quite quick. You're paying more than your 1-2%, which was their selling point at the time for mutual funds in the 70s, 80s, and 90s. That's why you did it, because it was easy, it was simple. But now you have a simple way to invest directly into companies on your phone. If you want to be super cheap, go download Wealthsimple. There's $0 trading. There you go. And those fees are disappeared, and you can recreate. You could technically, if you really wanted to, you can even recreate an ETF for cheaper. Like it's getting that absurd these days.
Yeah. Like, and I've had like quite a few conversations with like new clients who will sign up. They'll want me to quickly take a look at their portfolio and be like, can you like tell me what my advisor has me in, and we'll go through, and it'll take some time. But, in many cases, all of a sudden they're holding, 200 to, 400 stocks. And even the ETFs, like there is some overlap between, the ETFs, where all of a sudden the highest position in this one ETF and this one mutual fund they're maybe doubled up on a specific company. And I mean, if it's a good company, that's fine to be, a little bit overweight on. But again, just, the advisors placing them into these, mutual funds, and they haven't even really looked into, the fund facts of, either the ETF or mutual fund to really know what it is invested in, other than just, the name of it.
Yeah, and the point is, like, our clients are coming to us typically not to just mirror the market. They want to try to create wealth, build it over time. So if you do that and you build it in a traditional methodology, you own hundreds of stocks through ETFs, mutual funds. If you have a Boyd, if you have a Hammond Power, if you have a Jana or Water Furnace or any Expel, any one of these companies that has gained thousands of % that we've recommended over time, if it's one of hundreds of stocks you own in your portfolio, it's fine. It helps a little bit. But if it's one of 20 stocks you own in your portfolio, it, like we showed there, just even in a $500,000 portfolio, it literally changes your financial future over a 10 to 20-year period. Like, it changes the outlook of your entire family's finances over that time. And that's where, you can create true wealth in your portfolio. Warren Buffett, doesn't own 500 businesses, right? Like, because then they start to become a smaller needle mover in his portfolio and the overall portfolio of Berkshire Hathaway. Now, like, or his portfolio individually, there's been studies on it, and it's about 78% were in 8 individual stocks. Now, we're not advising to do that. I mean, that is Warren Buffett doing that. But if you want to create wealth, again, we'll talk next week. Not 2 to 3 stocks, not 50, 100 stocks, but there's a sweet spot in there that you can hold a simple amount of stocks that is easy to do through one of the discount brokerages. It doesn't cost you a lot, and you can get to know those businesses, or you can have us get to know those businesses for you and just, buy the companies when we send off a buy recommendation. But you can get to know those businesses. If you own hundreds of them, you don't really know what you own in your portfolio. And like when Brennan's saying people send in their portfolios to us, they don't know what they own. If there's hundreds and of stocks in there, even, we see some people owning 80 individual stocks plus, and then plus 10 mutual funds. They're just compounding on top of each other. And of course, within that, you're paying the mutual fund fees, but you're paying the advisor 1% to 2% on top of all that. When you have hundreds of stocks, you've just got the market return. You can't best the market once you get to a certain point, because every stock, you've just become the market. You're a proxy for the market, and then you're getting charged for that. It's quite disgusting, to be honest, that an advisor creates a portfolio that's over diversified like that and then charges a fee for it.
Yeah, whenever you hear the term passive investment or index investing, anything like that, you should not be paying anything really for it. You should be paying 10 to 30 basis points for the product, and that's really normally just their trading fees and some very, very basic management from them. And that's what it should cost these days. You shouldn't be paying, I very commonly see 1-2% for things that are very simple. An S&P 500 ETF, the most common ETF, you'll see SPY in the US, which is the most common. And then you'll have a mutual fund, another ETF, copying effectively the same thing, even if sometimes they don't even say they are. But once you actually look at the holdings, they're closet indexers, and they just match the index or very, very close. They might very slightly shift it, but they might add 0.1% of return in the year from whatever activity they're doing, and they're charging you 1-2% for that active management. And fund managers like that are absurd, and it puts the whole industry at really in a bad taste.
The funny thing is, like, parts of this we didn't even plan to talk to today about, but you can see it kind of grinds our gears. We talk about it in the office all the time about these fees that we see investors being charged, that ridiculous. They don't need to be fees. They don't need to be paying them, and it eats away on your retirement savings, and that bothers me, and we like to talk about it. So we talked about it a little today. We'll probably talk about it more in another segment. Now, we've got Brett's going to look at Sabio Holdings. We might as well move on to that before my dog comes in and mauls me. I think I've heard some barking going on over there. So let's get to Sabio Holdings, SBIO, and the TSX venture. Unless there was something else you guys wanted to say before I cut.
No, I think that rounds it off good. We'll have more time to rant next week on it, I'm sure.
Good to hear.
So Sabio Holdings, symbol SBIO on the TSX Venture, is an ad tech company focusing on connected TV and mobile ad monetization. Sabio's platform reaches 110 million TV devices, and that comes out to 55 million validated TV and mobile households on platforms like Roku, Amazon Fire, Apple TV, Samsung TV, Vizio, and LG, amongst others. So really anything that's like a smart TV is what they're trying to target. But looking at the share price over the past year, it's been pretty poor, to say the least. It had a dramatic fall over the past year, falling 64% to only 27 cents a share, resulting in a market cap of only 13.3 million. So why has this happened? Looking at the financials, which are just, in US dollars, even though it is a Canadian company, you always need to account for that. Total revenue actually fell 2% to only 6.4 million from 6.5 in the prior year. Notably, however, though, this is due to a fall in mobile ad revenue, falling by 50% to only 1.25 million from 2.5 million the prior year. At the same time, the connected TV and OTT streaming revenue increased by 29% to 4.9 million, offsetting the majority of the deficit caused by the mobile. This is really due to the company's plan to focus on the connected TV segment, as the mobile segment requires higher customization. Think about your phone and how many various different phones there are. It needs to be sized to that device, needs to operate on that device properly, where TVs are a lot more standardized. There's less models and they're more similar resolution. So it ends up costing less to focus on the connected TV marketplace. So it does make sense them doing that, but obviously it has hindered their growth. And as well, even though they're saying the cost will decrease at this time, we're not seeing that yet. The company's gross margin fell to 59% from 62%. Management attributes this to a shift in offering lower rates to secure larger and longer contracts, which should lower acquisitions over time. The result of this is overall gross profit fell by 6% to 3.8 million. However, like I was saying, the costs are expected to be lower. The company has lowered its operational expenses by 18% to 5.4 million, which does bode well for operational leverage. When you have that lower fixed rate base, you don't need as much revenue to hit that profitability, to hit that break even, and then have that exponential growth after that. So it is something good to see. Is they did obviously cut back on their mobile revenue, but it actually did come back on the cost as well, which is good to see. Net loss. There is still, of course, a net loss, though. It did improve, though, to a loss of 2 million from a net loss of 2.8 million in the prior year. As well, adjusted EBITDA improved to a deficit of 1.3 million from 2.2 million. So overall improvements, but still the bottom line just isn't there. As well, the share count did increase to 50 million from 47 million, which for these companies is good to note, because when micro cap environment, especially for equity markets, is just extremely hard to raise. And you'll see some of these companies, they double their share count year over year just to cover their expenses. So you do want to watch out for that for these smaller companies at this time. The company is, however, expecting a boost in 2024, specifically from political ad spending for the US election, with an expected double-digit revenue increase for the year and a year of positive adjusted EBITDA. So the financials are really looking to improve, but I would be slightly cautious just looking at it as the long-term run rate, as US political ad spending will likely fall in the next year, but then it would likely increase during the midterm election in 2026. So you can see that TikTok kind of variance every year due to the US political cycle. So you can't just say, oh, this year was great, next year is going to be the same or better. You have to really pull back a bit whenever there's a US really election during that year and adjust for the next year. Additionally, the company is benefiting from being a non-cookie based platform, which cookie-based platforms, those annoying little pop-ups you're getting, that has been really increasing due to regulatory skepticism. It hasn't really appeared in the US. Some of the states have done it, but not on a federal level yet. But with your pop-ups, you're seeing that because the EU has really implemented those pop-ups to be forced, which is why you get them all the time now. And they don't leverage those cookies, so they are a beneficiary of that regulatory change. However, switching to the balance sheet, the company holds 2.3 million in cash. They have 6.4 million in loans, 2.3 million in leases. So that ends up with a net debt and lease position of 6.4 million. As well, the company does have a weak current ratio of 0.65, primarily due to that large accounts payable on their balance sheet at this time. The company does expect to put cash generation towards strengthening its balance sheet in the next year, as they are expecting this better 2024. But that is something you really want to watch with this company, is the balance sheet is weak. It's in a precarious situation. If things do not go as planned, then that can obviously cause some problems. However, for Q1, we can see just the cash weakness is really reflected in the cash flows as well. Before the working cash from operations, or FFO, as we like to call it, it was a deficit of 1.6 million, which is an improvement over the prior year's 2.4 million. Cash from operations, which includes the working capital, was an increase of 2.3 million due to the significant collection of accounts receivable of 4.9 million. However, you can't have a constant decrease in accounts receivable. You only have so much of it. So it's not something you can really say, oh, they went up by this much because they decreased their accounts receivable. That's just not something you can do in any company. But just saying as well, that higher accounts receivable than the drawdown is really seasonality. You have a uptick in Q4 ad spend, of course. And so they issue their invoices in Q4, they collect in Q1, you have that big increase in accounts receivable in that Q4, then it comes down. That's expected. And that's why we want to look at something like FFO, because it really more normalizes that wonky working capital changes throughout the year. As well, though, you will probably see similar things even exacerbated during the back end of this year due to the election on top of the usual seasonal cycle. So in that Q4, you could likely see a very high uptick in revenue and then accounts receivable, and then the same thing in the following quarter in Q1 2025 of where accounts receivable gets drawn down. However, the only valuation metric we can really look into this time is due to not being profitable. Price to sales is only 0.3 times. This does look cheap, but it's not that cheap because of the lack of profitability and overall growth over the past year with a weak balance sheet on top of that. So yeah, really we have to just rely on price to sales. It does look cheap, but there is a reason why it's cheap, which we were discussing before. So the bullish thesis for the company is Sabio is able to successfully transition from its former mobile focus to the current OTT and CTV focus, and then have the ability to grow on top of that. They have the reduced costs, and they can leverage that, operationally leverage the company going forward. 2024 is looking to be a stronger year, but that does not completely negate the current issues. The company does have a weak balance sheet that needs to be repaired, as is currently in a precarious situation. And if the outlook falls apart or anything for any reason, whether it's management's issue or it's just something completely external, if there's a recession that reduces ad spend, something like that, they would have serious issues. So there's significant risk, even with a rosy outlook at this time, and they could quickly run into liquidity issues due to that lower current hit ratio if they weren't able to collect money or weren't able to have additional sales. So before being a serious candidate, the company does need to fix its balance sheet. Further, the company needs to prove it can actually be profitable. Right now, the company is only guiding towards adjusted EBITDA profitability, which is a weaker metric than GAAP profitability or even non-GAAP profitability normally, and especially given the weak balance sheet. So overall, 3 things we need to see before considering the company to be investable. We need to see the expected growth, which they are forecasting. You want to see management can actually be trusted with their guidance, because some of the management, especially in growth companies, they'll way overshoot, say they're going to double, triple revenue, and then they end up getting no growth at all. You see that relatively commonly with growth companies. So you want to see they can actually hit their mark with what they're guiding. And then further, we want to see profitability that leads to positive cash flow. And finally, that repaired balance sheet. So for now, we will monitor to see if the company is able to transition its business model, and if that transition can ultimately lead to a financially appealing company.
I think it's a good summary. That's decent revenue growth over the longer term, although down from its 2022 highs. Ad tech, generally speaking, has just had a long-term problem of creating a strong or consistent profit or cash flow margin up and down in different periods. And you couple this with a weaker balance sheet, it just Sabio just doesn't make our criteria right now.
Yeah, and like we ended up, I'm pretty sure it was in 2022 in Vegas, we ended up interviewing management. And in 2022, that was coming off of 2 years of positive adjusted EBITDA. And even in our talk with management, like I've got in my notes here, and they're a little cryptic, so take this with a grain of salt, please. But I just had written here, positive EBITDA for the last 2 years. Asking about what they're looking for in EBITDA range, and I have written down here 16%. Again, that's not guidance, but clearly if that is something that they were looking to target in 2023 and 2024, or
Not there.
2023. Yeah, not there. So, again, we're interviewing many of these companies over the years, and I'm always pulling them back up to see what they've said, and just, see how they're doing, I guess, as well.
All right, well, that's going to end it on Sabio for today. Let's finish off with Cannara Biotech, symbol LOVE, Brennan's favorite symbol.
Yep.
Isn't this the year of love, or is this the summer of love? So is this the summer of Cannara for you?
I divulged.
Wasn't that one of the
I divulged way
predictions
too much to you.
at the start of this year?
I think
year of love.
It might have been. I think that might have been just some internal office banter as well. But
I don't know what we say on here or in the office. I'm never sure.
Exactly.
But now it's been said.
That's okay. We love our listeners and our clients, of course. So hopefully they can get a good chuckle at myself at my own expense. So yes, Cannara Biotech Inc. LOVE, LOVE on the TSX Venture, currently trading at a price of 68 cents and has about a $62 million market cap. So they're a vertically integrated producer of cannabis and cannabis derivative products for the Canadian markets. The company owns 2 facilities based in Quebec, spanning over 1.6 million square feet. And they have 3 flagship in-house brands, which is Tribal, Nugs, and Orchid CBD. One thing that I find that you see with a lot of these cannabis companies is they will talk about, their brands. Realistically, cannabis at the end of the day is a commodity. So I would keep that in mind. And as well, the company currently serves consumers in Quebec, Ontario, Saskatchewan, Alberta, British Columbia, and they recently received approval for Manitoba in March of 2024 and is expected to be selling by Q3 of 2024, which is what they're in right now. And again, they're just selling to dispensaries. They don't have their own dispensaries, from my understanding. So looking at the stock chart here, the share price is down about 18% year to date. But it is important to note, the one thing that I wanted to bring up here is that the company did a 10-for-1 share consolidation in January of 2023, reducing its share count from about 877 million shares outstanding to about 87.7 million shares. And I believe they're sitting right around the 90 million shares outstanding. I don't think that they've actually done a placement since they did the share consolidation. But that's just something to keep an eye on and to note. And as mentioned, the company has 2 facilities in Quebec, the Farnham facility with 170,000 square feet of cultivation room, and the Valley Field facility, which they acquired in 2021 from the Green Organic Dutchman, or T-God as some people know it, as for about $27 million, which has the potential to get the company up to 100,000 kilograms of cannabis production through the years as it expands this facility. So as the picture I have on the screen shows, which is from the company's Q2 2024 slide deck, as of January 2024, the company has annual run rate capacity of about 33,500 kilograms of cannabis and is looking to enter fiscal year 2025 with production capacity of about 45,000 kilograms. Now, moving to the financials, the important part. So this is for Q2 of 2024. Revenue increased 51% year over year. Adjusted EBITDA was up about 8.7% to 3.5 million. And net income was a loss of about 3.4 million or 4 cents per share, compared to a loss of about 600,000 or 1 cent per share in Q2 of 2023. Now, the decrease was primarily due to a decline in operating income, as SG&A expenses were up, as well as net finance expense was also up to about 1.5 million, as the company needs to service its debt. And looking at this debt, or looking at the balance sheet, the company has cash of about 3.1 million and debt and leases of about 49.5 million, providing net debt of approximately 46.4 million and a trailing net debt to EBITDA multiple of about 2.65 times. Now, I should also mention that the company sold a parcel of land for about 2.1 million in April of 2024, which isn't accounted for in my numbers shown here. And the company is paying a weighted average interest rate of about 8.8% on its debt. So generally speaking, the net debt to EBITDA multiple is getting to the higher end of where we would like to see it. But I will say at least the company is cash flowing to some degree. Now, looking at the valuations, Cannara trades with a trailing price to earnings multiple of about 11 times, an EV to adjusted EBITDA of about 6 times, and a negative price to free cash flow multiple, given trailing free cash flow was a loss of 194,000. So to conclude, I really think that Cannara is an interesting business, and I have reviewed the company a few times when we've done our CDR sweeps. But even going back to 2023 and looking at my notes from when I did come across the company, the company still had net debt of over 30 million at that time. The company does have a good runway of growth through expanding the Valleyfield facility and with entering new markets such as Manitoba. And they also have touted that they are gaining more market share in some of their markets, such as Alberta. Now, the 10-for-1 share consolidation has tightened the share count, but it would be great to see the company refrain from further diluting shareholders. Again, I haven't seen it. They have been buying back a very, very small amount of shares, which, I mean, is a positive, I guess. But again, it's very, very small. But yes, it would be nice to see the company not have to, serially dilute shareholders and then potentially have to do a consolidation again, like we've seen, many companies do before. Now, the business is fundamentally strong, I would say, with good revenue growth and a history of profitability and cash flow, albeit not completely consistent. It does trade with reasonable multiples of about 11 times earnings and 6 times adjusted EBITDA. However, debt may be a bit of a concern given the high interest rate, and to expand the Valleyfield facility further, they will likely need more capital. So the question comes, do they raise more debt, or will future cash flow suffice, or will they potentially have to dilute shareholders for expansion plans? Now, for companies in the cannabis space, I think that it screens pretty decent, but I would like it more if the balance sheet was in a net cash position.
Yeah, it's a good summary. I mean, we'll continue to look at the cannabis sector. There was a massive oversupply. There was far too much capital came into the sector, chasing less demand than originally anticipated. This is just generally speaking. Capital was easy, and this kind of created poorly run companies. As the weak pretenders kind of die out, the market flushes the entire segment. Over the next couple of years, there may be an opportunity. We may look at some businesses. Cannara has some promise. I'd love to see, Cannara find a Cannara with a cash-rich balance sheet that is profitable. That would be what's kind of missing from our equation here. And then, just look at how the supply situation is. When a sector gets flushed, there can be some, opportunities for some stronger players that emerge when everybody just says, I don't want to look at anything in this segment, because there will be some people, there is demand. There will be some people that make money in here at some point. But whether that happens this year, next year, or still 10 years from now, I'm not sure. But, the one fly in the ointment with Cannara right now kind of is the debt situation for a company of its size. If you had 20 million in cash and it traded at those valuations, and, then you'd have kind of a margin of safety. That you might, you could say, okay, this might be an interesting company. So we're on the lookout for a business kind of that matches some of the growth and has some free cash flow, and then, probably has a better balance sheet.
Yeah, and that would be an area, because again, this is just a free podcast. I did a quick dive into it, but that would be an area of further research, is kind of
do for clients.
Well, exactly, that we would do for clients. And again, I'm not going to do it right here, but just taking a look to see what kind of capex they're expecting for these growth plans. Is it a couple million? Are they going to have to raise 20 million? Again, I don't know. Just from my quick in-depth research. But again, that is something that, we will dig into for our clients, of course.
Yeah.
Just one last thing. They may get a bit of relief soon because their interest rate is variable. They paid 8.75%, which it's not absurd for a company like this to pay that much right now. That's not that bad. Many of these smaller companies are riskier.
No, to be honest, I've seen higher.
Yeah, that's pretty good. Yeah, you'll see
I've seen 14.
13, 14%, yeah, for quite a few. And some of the very risky ones I've seen nearly credit card rate levels of interest.
Yeah.
But even then, you would expect that to come down because that is just based on a prime rate. So they might get a bit of relief, which then they can actually use that additional interest rate room to either pay off debt, which would be nice to see, or obviously fund additional projects as well.
So those are like questions we've had.
Mm-hmm.
Are you looking there? Is free cash flow not going for expansion now? Are you going to have to pay down debt, or do you raise equity again? And this company was a serial issuer of capital, and you know, it's you're robbing Peter to pay Paul. Like it's just I think for us to start to get involved in a company like this or start to look at maybe having a recommendation, it would have to have a flip on the debt. And that's not going to happen anytime soon without some dilution. So I mean, there's some companies that we could look at in this sector. This is one of them that we could look at. It's not one that we'd have a recommendation on at this point until there was something different either in this company. But I think we'd look elsewhere if we wanted to participate at this given time.
Yeah.
All right. I think that's going to end off our show. Mercifully, I guess we'll have Aaron back next week. Or, we do know that this will be the highest rated show of the year without Aaron here. So I don't know if it's actually good to have that man back next week, but we'll hope that he has a good vacation. Hope that his family, or he's not driving his family too crazy right now, and we'll see him next week. But if you are viewing this right now on YouTube, smash that subscribe button. If you're listening to this podcast, wherever you consume your podcast, rate and review us. Like I say, always, we love positive reviews. As always, I'd like to wish you profitable investing. Thank you.
Thanks, everyone.
Thank you.